everyone. Thanks for coming back to our topic about first-time home buying. We are going to have a panel of people talking about their specialties and what they do and how they can help answer your questions. It's important that we get questions, so please send them in and we will address them. It might be something that you think is a simple answer, but there's probably other people on this that would like to know the answer as well. So please send those in. I'm Carla Needler. I've been with BECU for 11 years, and I'm a mortgage advisor in the Seattle area. And then we have some others with us today. We're going to do a step-by-step roadmap on purchasing, which is really great because it's on a calendar format. So you can see how many days you have when you have your inspection and different things like that. And then we're going to just talk about like the pre-qualification on our website at becuhomeloans.org. You can go on there and click on pre-qualification, and you can put in your own information on your salary, your payments that you have every month, a car payment, student loans. The student loans is a really hot topic right now because they're all in deferment. But per Fannie Mae guidelines, with what we use, we have to count 1% of the outstanding balance as an actual payment, unless we can get something from your student loan company that indicates what the amount will be once the deferment is up. So the pre-qualification is not an approval, it's an estimate, and there's no fee for that. Our conditional approval is what real estate agents want you to have prior to showing you homes. They want to make sure that you've already been approved by the lender. So you're going to consult with one of us advisors. We're going to submit the application. We're going to verify your income and your credit and your assets. And then we're going to get you an approval letter that's good for 90 days. And now we're going to go over transaction timeline. So this is a fun one, a calendar showing if it was on a 30 days. Usually it's about a 30-day time period from when you put an offer on a home to when you close. And so we are going to, let's say that you put an offer on a house on Sunday and that offer gets accepted. It's important that you work with a real estate agent and a loan officer that work really well together so that they can coordinate when those offers are coming through on Sundays, that they're texting with one another to get over pre-approval letters. But once it's accepted, we're going to have an inspection, and so we need to have there's a certain amount of time before that you have only a certain amount of days of when you can get the home inspection done. So we want to make sure that gets done as fast as you can so that you can make sure you really want to go forward with the home. So we are going to we're going to get a copy of all the documentation for with the contract, and you're going to send your earnest money over to the escrow company. And the earnest money is 1 to 3% of the purchase price of the home, more typically. And the earnest money gets deposited with the escrow company, and the escrow company holds that earnest money until the end of your transaction. Then they subtract the amount that you brought into your earnest money as your down payment. So it's really your down payment that they're going to hold on to. If you go to your home inspection and you realize that there's things with the house that is just too much that you don't want to take on, and there's a lot of issues, you can cancel the transaction and get your earnest money back at that time. So once everything's been negotiated, a lot of times what will happen is there's always issues with a home, even if it's a brand new home. And you'll go to the seller and say, I found these problems with the house. I would like you to address them. So you can have have them fix items that are wrong with the home, or you can ask for a seller credit. So you can get a credit towards your closing costs for whatever it would take to repair those items. And then we got your home inspections cleared. We're going to order your homeowner's insurance. You're going to shop around for that. You're going to pick who you want to choose to use for your homeowner's insurance policy. And then we're going to order the appraisal. So we need the appraisal to show what the value is on it. So the appraisal is quite a few pages, and it will show different comparable sales in the area that you're purchasing with the same square footage and room size and bathrooms and things like that. And once that appraisal comes back, we want it to come in at the purchase price. So we want that to come in clear and that there's no issues with the home. And then we might need to have more documents. So and as we're doing all of this, we're also coordinating with the appraisal company, with the title company, the escrow company, with your agent, with so the selling agent. So there's a lot of moving pieces and parts and people involved in the whole transaction. So it's just all streamlined that we have to all work together to get to the very end where you get your keys. So yes, you set the escrow appointment up for your signing. You sign your loan documents, and then you're home. Then you get your house. Now we would love to hear your questions. And our other panel, here we go. Yay! Okay, here's our friends. So please introduce yourselves. Chad, you want to start?
Sure. I'm Chad Johns. I'm a fellow mortgage advisor at BECU. I've been doing mortgage loans for about 8 years, 5 years with BECU Credit Union. I am located over on the other side of the state, over in Spokane or Eastern Washington. So I primarily work in Eastern Washington and Northern Idaho, helping our members over here secure financing. So that's me, and I'm proud and happy to be involved with the Member Summit. It's always a great event. So I'm glad we could get the panel together. So yeah, Callie, take it over.
Hi, everyone. I'm Callie Lagoska. I am a realtor with Berkshire Hathaway, and I have been in real estate for the past 8 years. I specialize in working with first-time homebuyers and condos and HOAs, and I'm located in Seattle, but serve our Tri-County area of King, Snohomish, and Pierce counties.
Hi, everyone. I'm Ruth Kaneko. I am one of the financial educators here at BECU, and I get to have the pleasure of moderating these wonderful people and asking questions away. At all of them are just a breath of knowledge. Let me tell you, they've got some fantastic ideas, and yeah, so that's my role tonight. So we're going to go ahead and fire away if that sounds good to everybody. Does that sound good? All
Yes.
right. All right. So one question came in. Does the first-time homebuyer grant program cover a modular home, not a manufactured or mobile?
You want me to take this one?
I'll take this to Chad. Yep. Chad, I'll put that to you.
So typically a modular home is a home that's pre-assembled off or built off-site and then assembled at a site, a construction site. Most of the time that looks and feels just as if it was a stick home. And so as long as there's comparables out there, we would be fine using our first-time homebuyer grant on a modular home, as well as a manufactured, because you did specify in that question. Great question, by the way. Are manufactured homes allowed? And that's a question, I don't know how much you guys get over there, but that's a question we get a lot over here on this side of the mountains. And we do allow manufactured homes as well to be financed here with BECU. That is going to be a double wider, larger manufactured home. Okay. It's got to be title eliminated. And what's that mean? That means that you're buying not only the home, but the land that it sits on as well. So a lot of people will say, hey, I found a home in a park. And what that means is they own the home, but they're paying lease rent or lot rent on the land where the manufactured home sits. So it's got to be on permanent foundation. It's got to be not on leased land, and it's got to be a double wide or larger. There's also some specific rules as to when it was manufactured. It has to be built after June 6th of 1976. So that means it has to be manufactured after that date. And these are Fannie Mae guidelines that I'm quoting, which is exactly who we underwrite to. So modular home, you should be fine, because most of the time, unless you're an educated eye like Callie, you're not going to be able to tell the difference if it's a modular or a stick frame home. And a lot of just generic people wouldn't know a difference. So great question. And like I said, we do allow manufacturers with the grant as well. So it's really a great program.
We had another question about the grant program as well. And let's see, Carla, is there an income limit to the first-time homebuyer grant program?
There is, yeah, and it depends on where you're looking at to purchase. There's something called area medium income limits, and if you go to you could Google it and it will pop up with a map, and you could put in an address or put in Seattle, Washington or Spokane, Washington, and it will populate and show what the income limit is for that area. So like King County, of course, is going to be different than Kitsap County. There's a lower threshold for Kitsap than King. So ours in King, Pierce, and Snohomish County is 124,600 is what that limit is. Chad, what is yours?
Well, they just changed on Saturday, right, Carla? So
Oh
ours
yes, I forgot.
Yeah, so ours just went up. It was 83,800, and it's now up at 91,000. And I forgot if there's some change on that or not. So around 91,000 in Spokane County. Kootenai,
I've been waiting for that to happen. I'm excited.
Yeah,
I need to go do some
out.
research.
Yeah, so roughly 91,000 in Spokane County. Kootenai County usually trends a little bit behind that. It was 76,000, but with the new update, I'd imagine that's going to be in the 80,000 range. I haven't checked it yet, so good question.
Awesome.
So we are getting a lot of questions about the grant program. Another one is, can the BECU First-Time Homebuyer Grant be combined with other down payment assistance programs that are also available? For example, those through the WSHFC.
Great question. I can take this one, Carla, since you had the last one.
Sure.
So the grant does not cope up with the Washington State Down Payment Assistance Program. Our grant is kind of what we've made available for our members. That's similar to the Washington State Down Payment Assistance Program. Okay. So the Washington State WSHFC.org, if you want to Google it and read about it, will tell you exactly what programs are out there. What we want you to be conscientious of as a borrower is looking to see if that is a grant that they're going to give you, or is it actually what we call in the industry a silent second loan. A lot of people don't qualify for their grant program, in my experience. It's much harder to qualify for than our grant. You have to be at the lower level of income or maybe have a disability in order to qualify for it. But a lot of times they'll give you money. They'll give you a silent second on your loan. That usually depends on the parameters, is a zero interest loan up to $15,000. They maybe change the limits to where they'll give you $15,000. And then when you pay off your first term, your main loan, if you pay it off, you refinance it or you sell it, this $15,000 comes out of a box. They call it a balloon payment. You know why? Because you open the box and the balloon comes out and says, hey, guess what? You owe us this $15,000 you borrowed 25 years ago. And they're going, oh my gosh, what do I do now? Right. So it's a great program. I did a lot of them at the brokerage, but if it really compares to our grant, you're talking about getting a loan for your down payment as opposed to us granting you funds. So, but you can't couple them together. They don't work together at all. Carla may be able to chime in on this one. The only program that I think that will be allowed with our grant would maybe be a native tribal Indian type of down payment grant that they would couple with that. Like you have a tribe that you're a part of or belong to, and you get money from them. We could use that and our grant together, if I understand that correctly. But other than that, it's kind of its own grant.
And Washington State Bond Program, they set the interest rates. So if you are coming to BEC, you're going to get interest rates that anyone can get that's buying a home. But at Washington State Bond, they set the interest rates, and they're usually a little bit higher, and they cost, like, there's an origination fee a lot for that. Yeah. But don't get us wrong. Sometimes that is a better fit for people. So we will definitely want to help you to determine that too.
Yeah. And I usually tell people, when they're in my office, that same thing that Carla said is be aware their interest rate seems to trend about 1% higher than what we would quote you for conventional just conventional or FHA mortgage loans. The rate seems to be about 1% higher, as well as most of the time there's origination fee with that. If you don't want to charge the origination fee, then the rate goes even higher than that. So, and it's all posted. They post their stuff on their website. But in hindsight, it can be a great program if you needed your money for closing costs and the seller's not willing to grant you closing costs, and you have literally zero assets to contribute. Unless you're a veteran, this is the only the Washington State DPA is the only program that I'm aware of that you can literally get in with zero to little cash. So usually my thing is, hey, can you save up or get a grant or gift, and then we can get you the grant, because all you need is your closing costs, right? Because we know those are out of pocket. We know those average around 2 to 3% of your purchase price. So, I think that hopefully answers your question in a long form there.
Absolutely. And I kind of tacked onto that. The same person was asking, in terms of the income limits for the grant, is that adjusted gross?
Yeah.
It's gross income.
Yeah.
Okay.
Yeah.
Perfect. Thank you.
And it's
Kelly.
combined household. So if you and your
Mm,
wife are, if your partner are on the application together and purchasing, it's your household income combined.
Yeah.
makes sense. Thank you. And what is the cost? One person was asking, what is the cost for working with a realtor?
Yes. So, talking about saving for closing costs and down payment, you do not need to save additional funds to pay your real estate agent to represent you as a buyer. Your real estate agent is going to be compensated when you purchase the home by the seller through an agreement that they have initially made with the listing agent. So, the only time that you might need to save some additional funds to compensate your broker for representing you would be if you are interested in a property that is for sale by owner. Very rare circumstance, or if your agent has worked through a buyer agency agreement with you. So you would know in advance, working with that agent, if they expect you to cover any difference of compensation that the seller is not already providing.
Lovely. Thank you. Another question for you, Callie, came in is what are some tips on negotiating a home that's been on the market for a while?
Yes. So the market has changed a little bit, and we are starting to see some homes sit on the market longer. There can be different reasons for that, whether it's condition or just that the seller started with a price that was too high for market value and a buyer didn't want to pay for that. So when you negotiate, you can negotiate to bring the purchase price down, or you can also negotiate to have some seller paid closing costs. And this is really helpful if you know that there are some repairs that need to be done on the home and you wouldn't have the extra funds in addition to your closing costs and down payment that you're putting into the purchase to cover those repairs. But additionally, Carla and Chad can talk about using those seller paid closing costs to buy down your interest rate in your loan and make your housing payment a little bit more affordable.
We saw that a lot. We had like a little bit of time where we were having that sellers were actually giving people incentives to buy the rate down because the interest rates that did cause a little blip in in the selling homes, and now we're right back into it. We're all busy with home selling, but yeah, we did see that we're able to use up all of the seller credit to be able to buy the rate down or pay closing costs or whatever.
Yeah, so sellers can pretty much contribute up to, it depends on your loan type, but traditionally with conventional loan, 3% of the purchase price towards your closing costs and funding your escrow account. And so what we'll do is we'll buy your interest rate down, like Carla said, to get you the lowest interest rate possible by utilizing potentially all of the seller credits, which was common. And I'm still seeing it about half of the deals that I am on. Or like what Callie said is maybe after they go get negotiation and they figure out there's some issues, then maybe they're getting that seller credit at that time. So it's good knowledge to have for first time home buyer or fifth time home buyer, just these refreshers. So
yeah,
Wonderful.
and I
Okay.
wouldn't expect that you might be able to negotiate if the home has only been on the market for a week or maybe even two. The seller might be holding out and waiting to get some more exposure on the property before they agree to negotiate too much. But usually, 1 to 2% of closing costs is something that your agent can probably help negotiate after just 2 or 3 weeks on market.
Wonderful. Thank you. Another one is Callie, this is for you specifically. Should I go to an open house or go to a showing with a real estate agent? What are the pros and cons of both?
Yes, so it is really fun to just go out around the weekend and tour a bunch of properties and go to open houses. But as a home buyer, you want to understand who is working at that open house. Often it is the listing agent or someone representing the seller. So if you become interested in that property, you want to make sure you have your own representation and working with an agent that's representing you and not the seller. But when you go to that open house, there's usually a sign-in sheet, some pamphlets, and the goal of the agent at that open house, if not to sell the home, is to pick up new clients and meet you as an unrepresented buyer. So if you give them your phone number or email address, expect that they will follow up with you. They're going to send you a lot of emails. So if you didn't click with them right away, just be cautious of giving them your personal information. But if you are serious about buying a home, pair yourself with your own real estate agent. I love to go tour properties one-on-one with my client because we get to speak freely. We can look at and spend a lot more time and looking at a lot more things in the home versus bumping elbows and trying to walk around other people in the property and being careful about what you say. Because if you walk in and say, oh my gosh, I love this one, or things like that, everyone's going to hear you. So having your one-on-one appointment with your own real estate agent is really valuable.
And going off of that with like a home showing, what are some things that you would tell your client to expect when going to a showing that they should be aware of? Like, for instance, don't, I love this house.
Yeah, that's great because this time and age, we have a lot of homeowners who have cameras on their property. So whether it's the Ring doorbell at the front door or the pet camera inside, you do want to be careful about what you're saying in homes. But when you go to a property to tour, what you can expect usually with your agent, when I work with clients, we look at a lot of different things. We're not acting as the inspector, but we are checking the condition. So we're looking at the windows. Do they have any failed seals? Are we checking the age of the water heater? What type of furnace are we working with? Is it oil, gas, electric? We're looking at a lot of that stuff that might be important to the buyer before they even get to the point of paying for an inspector to come check out the property, as well as we're going to look for things that an appraiser might call out. So if you're getting a home loan, you need to be aware that the appraiser is going to check for certain safety and building code things like handrails on stairs. They're going to be checking for earthquake straps on the water heater as a safety feature, as well as carbon monoxide and working smoke detectors. So these are all things that we can look at initially, as well as the layout and the size and the backyard. But it just gives you more time to be in the home instead of a quick 5-10 minute tour at an open house.
All right, thank you so much.
We see that sometimes on appraisals. There won't be a handrail, and so we'll have to have the handrail installed, and then the appraiser has to go back out to make sure that it's been done. So that's healthy and safety issues that we have to see on those pictures.
Well, thank you. Another one that came in, and I know a lot of this is kind of top of mind for everybody for sure, are student loans, right? What is going on with student loans? How are those calculated? And so we have a question that says, how are student loans calculated these days? They are on deferment, they're coming out of deferment pretty soon, maybe possibly for the person. How are those calculated when purchasing your home?
So student loans, we have to count 1% of the outstanding balance as a payment for the student loans, unless we get something from the student loan company that indicates what your payment will be after deferment. Then we can use it. We can use that, which is something that came out after Joe Biden, when President Biden gave, saying that he's going to do the forgiveness. Well, everybody's on deferment, and so then all of a sudden 1%. To some people, it was like a lot of the payment, and so they wouldn't qualify for as much. So then a new ruling came out from Fannie Mae that said we'll allow, if you have documentation indicating what a payment will be after, you can use that calculation. So that was a way that we kind of were able to get around that. Because Chad, I'm sure you probably saw that as well. Yeah,
a lot for sure. I was going to add, so what we call that is a common term for it is IBR, income-based repayment, right? And so us as lenders, maybe you were on an IBR prior, and then you don't have to make a payment because they're all in forbearance or whatever you call it now. And we're counting 1%. Well, that is a lot to some people. To some people, it's not a big deal, right? Just depending on their income and their debts and stuff like that. So I've actually had clients that have a lot of student loans, and they're like, well, there's no way I'd really pay this in real life, Chad. And I go, I know. So can you please go provide a letter from Department of Education that shows what your IBR payment will look like once the forbearance ends, right? You still don't have to make a payment on it. We just want a paperwork to show that. And so like Carla said, once we get that paperwork, we can put that in the file and say, hey, no, look, the new student loan payment's going to be this much. So that's what we know today, right? We don't know the future, if they're going to, whatever's going to happen, we don't know. So we have to talk in today's rules, and those are today's rules. And when Carla talks about that, she talks about the F8, that's the conventional mortgage loan rules. FHA takes a half a percentage point of the loan amount and counts that against you. So just a little tidbit to add to what Carla had to say. But other than that, she's spot on. Yeah.
Wonderful. Thank you. Another question came around a lot of what earnest money is and how much should I give for earnest money? What should I be looking? What's a good percentage to kind of go by when you're thinking of how much I should put up front for earnest money?
Yes. So earnest money is what you will write into your offer as your good faith to the seller. You're saying, seller, I want to buy this property, and escrow, the third party that's going to transfer the sale from the seller to the buyer, they're going to hold that earnest money for you until all the contingencies in your offer have been satisfied. And it is applied to your closing costs and down payment at the end, at the closing process. So you don't need to save additional funds for your earnest money. But typically it is 1% to 3% of the purchase price. Of course, buyers can put more in earnest, but you don't want to be too high in this amount because it is what we would consider at-risk funds. If you were to change your mind about the property and you don't have any of those contingencies left in your contract to fall back on, that money could go to the seller. Very uncommon. Your real estate agent's number one job is to keep you informed of those deadlines and protect that money for you. But things happen, and sometimes you change your mind and you don't have any outs. You have personal things happening in your life, and if you've promised $20,000 to the seller in earnest, that's a big chunk of money that you're not going to be able to use to go buy another property in the future.
And I have to say, all the years that I've done mortgages, I've only had to, one time somebody had to give up their earnest money, because there are so many different time periods where things have to meet requirements that you're able to get your earnest money back. And rightfully so, he did have to pay it because he waited till at the very end of the transaction, then decided not to go through with it after everything was complete, been through underwriting and everything. So all the loans that we've done, I've only had one time.
Do you see it? Just a question for Callie, more or less. Do you see when the market shifts, do you see more people putting more earnest monies down to make themselves appear that their offer is stronger?
Yes, that would be one reason to go on the higher end of a range for earnest money, to show to the seller that you're very serious. So when you are in competitive situations and multiple offers, that is a component of the offer, but I wouldn't consider the earnest money having a huge weight in the rest of the terms. So your offer will be looked at in whole. Whether it's your inspection contingency timeline, your closing timeline, what type of loan you're getting, all of that might be more important to the seller than the earnest money, because their ultimate goal is to sell the home and receive the proceeds from the sale, rather than they're really not out to get your earnest money. That's not their goal in the transaction either.
Wonderful. Thank you. Another couple of questions that are coming in is around PMI. And a lot of people ask questions around private mortgage insurance. What is it? Does PMI stay on the loan forever when you get a home loan? And how do you calculate how much PMI you may be spending?
I'll take that one. Great question. So PMI stands for private mortgage insurance, and you will pay that on a conventional mortgage loan if you choose to put down anything less than 20%. That will automatically disappear at 78% loan to value. So you can call and have it removed at 80%. So once you reach 80% equity or 20% equity position in your home, you can call your servicer, BECU, and say, hey, I'd like to have this removed. I've been paying down my mortgage, and guess what? My house has gone up in value. At that time, they'll look at the case and either remove the PMI or keep it on for whatever reason. If you forget to call, because a lot of times you're just making your minimum monthly payment and you only put down 3%, it's years and years before you get to that 80% loan to value. So the federal government has mandated it that it automatically drops off at 78%. Now that's with the conventional mortgage loan, okay? With a FHA mortgage loan, no matter if you put down 20% or 3.5%, which is the minimum with that product, you will have mortgage insurance on it for the lifetime of the loan. Years 1 through 10 is a fixed premium, and then it does go down years 11 through 30. So it does go down, but it will never go away with that loan type. So a lot of people will maybe utilize an FHA loan to get into a home for whatever particular reason, FHA is popular with less than stellar credit, or what I like to call maybe job jumpers who have had a lot of jobs in the last little bit of time. They're a little bit more lenient on those things, which allows you to get approved, but then you're going to have that PMI on it for the lifetime. To answer the question about what will PMI cost me, that factors into that is the type of property you're buying, right? So what type? Is it a single family? Is it a manufactured? Big thing on PMI is your credit score, right? So always pays to have good credit, like we talked about in session 1. And then another thing is, how much are you actually going to put down? Are you really close to putting down 20%? Where you're probably not as great of a risk as defaulting on the loan, or you're putting down very minimal on the loan. So, and that's called the loan to value. So those are the pretty much the main things that we will look, or PMI looks at, private mortgage insurance companies. Here at BECU, we have 5 private mortgage insurance companies, and we'll choose the most affordable for the borrower. So we go out and quote the 4 that we have, and we go with the lowest quote provided. So we'll guarantee you we can try to get you the best out of the 4 that we work with. So hopefully there's no set finite cost for PMI. It differs depending on your particular profile, your loan profile, and your property profile, if that makes sense.
And mortgage insurance covers a lender just in case you default. So that's our, like you said, it's our safety. Like, they don't have 20% down, so we're going to have this mortgage insurance just to make sure that we are getting our value back, or our loan, right?
Yeah.
And Chad, you actually you touched on this a little bit ago. Question is, what is the difference between a conventional loan, an FHA loan, and a VA loan?
Oh, that's a great question.
The specifics of those?
So one of the main things that I always like to hit, well, Carla's, we've done this long enough that back in the day, FHA was a lot more competitive with their interest rates, right, Carla? That everybody wanted that lower interest rate. If today I was to quote you, I won't, but they're exactly the same, right? So there's no rate benefit, right? So that's the main thing always people who get stuck in their head is, I want an FHA loan because I want the lower interest rate. And I'm like, well, that's not the case necessarily today. So we can
or lower down payment, they think.
Yeah, and then they also think it's a lower down payment. But if you're a first-time home buyer with BECU, we can go as little as 3% as opposed to 3.5%. Okay, so there's a difference there in half a percentage point of your down payment if you're a first-timer home buyer. The PMI, like we just discussed, is a major factor, right? So that PMI is going to be on there for the life of the loan. Another point that I like to bring up, which Callie was kind of talking about earlier, is the appraisal process with an FHA loan is much more stringent than with a conventional mortgage loan. And the reason why is the Federal Housing Authority really wants to make sure that home is safe for that buyer or borrower. And so they check every little nook and cranny. So, and that's the same as a VA too, or a government when these loans are backed by FHA or Veterans Affairs. They want their appraisal to not have any chipped in, or the home cannot have any chipped and peeling paint, for an example. If it does, the paint must be scraped, the paint chips must be picked up, and it must be painted, right? Or 2 stairs without a handrail. So if you're an educated seller, you have an educated real estate agent like Callie who's helping you sell or buy, they are going to find these just by quickly looking at the home and say, hey, you know what? You have an FHA loan. This has to get repaired on this house for me to help you buy it. Or if the seller is unmotivated, right? So the seller's going, hey, I'm just selling as is, fire sale. I got to get to Oklahoma because that's where my job's taking me. I'm not putting any more money into this thing. So you have to kind of understand that appraisal process is a little different as well. Besides the PMI, there's probably some more stuff. Those are the 2 main factors that always hit home with me. Carla, do you have anything else, or Callie, to add to that?
Well, VA loans are good for our veterans, but they don't have mortgage insurance. And so, did you just say that? And I wasn't listening.
No, I forgot to say that. The question was VA too.
I was like,
VA.
So VA, you could get 100% financing, so you don't have to pay mortgage insurance. And so that's a really great thing for our veterans to have. The funny thing about it, and I don't know why, I just think it's kind of strange in today's world that if you have a partner and you're not married, that partner, unless they have VA benefits, they can't be on the application. And it's just the weirdest. I think that they need to change that policy, I feel like, Chad, do you agree?
Yeah, that's
Yeah.
that's a kind of a weird rule that they have, because you may not be married yet, but you want to be, and you're going to be. I mean, how many times do we help clients that are, they're just getting together or they've been together, but they're not married, and we're going to get married next summer, but first we want to buy a house, and it's like, well, that's great, Carly, you're the veteran, you can be on the loan, but Chad, you can't be, if we
That's
were
so
married
true.
or something like that, and so
And
yeah,
and
that's
then
sort of
if your spouse,
weird.
if you are married and your spouse isn't on a loan application, we still have to pull their credit and we
Yes.
have to count their debt. Again, it's just a funny
Yeah,
Interesting.
the
thing I did.
non-borrowing spouse. So if they are married, the Carla, like she says, and the non-borrowing spouse is not even on the application, that one individual who is on the application needs to qualify not only for their debts but also for their partner's debts, and that's the same with VA and FHA looks at that as the same thing. So
Right.
you're married, okay, we need to look at your partner's debts. So we need to pull your partner's credit. So you need to be able to afford their debts plus your debts plus whatever the house that you're looking at potentially buying. Where on a conventional mortgage loan, if you're married, we're not going to look at partner's debts and count them against you. We're not going to pull partner's credit. You can choose to put partner on title if you'd like to or not. So a lot of times we'll do it for one individual because they want to remain under that area median income we talked about earlier to get the grant, but they want to put their significant other on the title. That's okay, but we're not going to look at them for qualifying purposes whatsoever. So
Very good question. Thank you for that. That was really good. Love that exchange there.
Well, and
go ahead.
VA too, I was going to say, VA has appraisers have to be VA approved to do VA appraisals, and in our system when we usually on a normal transaction or not normal, if it's a conventional or FHA loan, we can see that the appraisal's been ordered, and when the appraisal comes in on VA, we can't. It goes. Our processors have to order them. They get uploaded into a separate system, the VA system, for them to be able to pull through. So it's a little bit of a different process.
A couple questions just came in. How about USDA loans in rural areas? Do you work with those types of situations?
I can take that one. I'm a little more rural, but
Yeah,
we
you are.
don't BECU, we don't do any sort of United States Department of Agricultural loans. If you're looking at a USDA loan, you'd have to go to a broker or a bank that offer those type of loans. They are a zero down program. They're very much the same as VA as far as qualifications. Certain debt to income ratios more stringent on the process of things, and they got to be classified in a rural area. So you're not going to be using any sort of USDA loan in the city proper, right? My thing is it's pretty much like there's this town north of Spokane called Deer. I said to Deer Park to the Canadian border, you can use USDA all day long. But once you get down here in town, Spokane, Coeur d'Alene, you're not going to be able to use that type of loan.
Another question, the first-time homebuyer grant doesn't cover land, but it does cover modular manufactured homes. So how do you work with that catch-22 one person was asking?
Well, a land loan is completely separate than buying a home. You're not a first-time home buyer if you buy land. That's not a home. So we just got to go back to the basics of what the definitions are. Because a modular or manufactured, you're buying a property, right? That's securing the loan. You're not buying the land. I think.
And land is just raw land. It
Yeah.
wouldn't be, yeah.
Yeah.
Perfect.
And-
Thank you. Oh,
Yeah.
sorry. Go ahead.
I was just going to say,
Yep.
people, you can't live in raw land, right? You own it. You maybe camp on it for a little while, but you're not going to live in that area until you build on it, right? So.
Mhm.
Yeah.
And one question for Kelly, I know we're coming up in a minute here, but how does the market compare today to when it was 3 years ago? And is now still a good time to buy a home?
Oh, absolutely. There are so many opportunities out there right now for buyers. We are seeing a lot more inventory hit the market. So there's more options available for you. And I'd say 3 years ago, we were seeing a lot more competition when the rates were down in the 3 and 4% range. And as Carla mentioned earlier, we are at the higher, like 6 to 7%, but it is still fantastic rates. And we're not seeing much of a slowdown. So there's still a lot of people out there buying, but you have maybe more opportunities and more selections, but still limited inventory, of course, because there are homeowners that refinanced when those rates were low and now they don't want to move. They don't want to let go of that rate. But we're definitely seeing prices come down a bit more, and just plenty of opportunities out there.
Wonderful. Well, Carla, Callie, Chad, thank you so much for presenting and bringing your wealth of knowledge. We really appreciate it. And thank you, everybody, for coming to these sessions. Hope we learned something today. And again, we are here for you. If you have any questions at all, please do email us and reach out. We love to answer those questions for you. So thank you, everybody. Have a wonderful night. And we look forward to seeing you at the next session.
Have a good evening, everyone.
Thank you.